We're turning to FIIG Securities now, and we saw a big sell-off in bonds overnight on the back of rising oil prices, new Greek debt proposal, leaving markets a little more upbeat. For more, we're joined by Jonathan Sheridan from FIIG Securities in Sydney. John, what did you make of the bond market moves overnight, that big sell-off?
Good morning, Ingrid. Yes, really interesting that where we are now is pretty much where we started yesterday, before all the turmoil that was created by the cut from the RBA. So pretty much as we were, a big risk-on tone to markets with the oil price in particular, and the rumours still surrounding the Greek negotiations, as you say.
Locally, I mean, in terms of the bond market here, what are we waiting for? Is it the statement of monetary policy from the RBA on Friday, where we'll get a little bit more detail on sort of forward guidance, because we didn't get much of that in the statement? Is that what we're watching going forward?
Oh, look, I think just the tone is still, again, is risk on, and there'll be particular support from you know, central banks around the world, and now the RBA seems to have got on the bandwagon. I think the actual sort of appreciation of bond prices will be a side effect. I think really the key message that central bankers around the world are trying to put out there with their monetary policy is that it's really about currencies. I mean, that's really what Glenn Stevens was focused on. He talked a lot about a lower Aussie dollar is needed to rebalance the economy. And it's really about sort of a race to the bottom now. I think it's, you know, Glenn Stevens has tried to fire his first shot in the currency wars that are happening around the world.
Do you see, is it, you know, being inevitable that we stop after two in that environment? It seems, as you say, if it is a race to the bottom, that implies there's kind of no limit on going still further.
Yeah, I think anything's possible. I think we're in unprecedented territory. I mean, if you look at the Swiss bond curve, for example, you've got negative rates out to about 12 years. You know, Macquarie Bank issued a bond in Swiss francs yesterday that pays them 12 basis points a year for 8.5 years. You know, I just think that's kind of ludicrous, really, if you just think about it logically. So I don't think we know where we might stop. You know, before we did QE for the first time, no one thought that could happen either. You know, so I think it's all about the currencies, to be honest.
Hey, just moving on to local sort of corporate bonds, because that ANZ hybrid, which has been in quite a lot of focus of late, has priced it. You think it's a bit expensive, though?
Yeah, I do. I mean, I think as an outright yield, it's around 6.4% to the end investor, but that includes franking, so you won't receive 30% of that until you do your tax return. If you just compare where the banks here are pricing those hybrids with Europe, I mean, that's at the really, really tight end of the range for the, you know, super strong banks over in Europe, and I just think that they should be really with at least a 4% margin on the front of those bonds. Well, on the front of those hybrids. I wouldn't call them bonds; they're much more equity-like.
Who's next in that sense? Who's next to come to issue?
Yeah, well, NAB are rumoured to be coming in a couple of weeks, but their proposed deal, I think, will be 5 years as opposed to the 8-year non-call period we've seen from this ANZ bond, and the pricing on the NAB is supposed to be around that 360 level as well. So, you know, 3 years less exposure for the same price. If that actually eventuates, then I'd much rather own the NAB one than the ANZ one.
Okay. Interesting. So it's not first mover advantage in that sense.
Well, and look at CBA. You know, they did Pearl 7 at 280 before Christmas. So
the moral of the story is hold back.
All right, John, we'll leave it there. Thanks a lot for joining us.
Thank you.
Slow and steady wins the hybrid race.